other financial institutions packaged it into something that's a derivative. When you invest in a derivative, you're not actually investing in the underlying asset. You're just following the fluctuations, but it also has a high amount of leverage. That's why when everything started to falter, a lot of people got hit because of all of these combinations that I'm actually talking about. Another thing that I'd like to mention is this, that there were some regulatory failures that happened at that particular point in time. The regulators failed to keep in pace with the rapid innovation of the financial industry, and the existing regulations were often inadequate to be able to address new risks. And over the past few weeks, we've seen a lot of fear, uncertainty, and doubt because we've seen the likes of Silicon Valley Bank, we've seen the likes of Silvergate, we've also seen Republic, then we've also seen what happened to Credit Suisse over the past few weeks, and people have been saying this is like 2008 all over again. In this video, I want to talk about what happened really in 2008, and is it really the same as what we're actually experiencing now? So just to give you a context, that one of the biggest things that hit in 2008 was the bankruptcy of Lehman Brothers, and that caused everything else also to spiral, and then you had the global financial crisis happen. One of the biggest things that contributed to it was the subprime mortgage lending. Banks were lending out money to people that didn't really have the capacity to actually pay. They were pushing people also to borrow, get another house, that actually caused them also to actually spend more over the long term in a way that wasn't actually sustainable for them as well. One of the biggest things that caused all of those dominoes to fall, we saw a lot of banks lend it to people who didn't have the financial capacity to do it. And then when times got rough, when interest rates got higher, a lot of those people, since their credit ratings were so bad, they weren't able to pay for those housing projects, and the value of the houses that they had were cheaper, lower than the interest that they would have paid as well. That's why a lot of them started to default on those loans. What makes this very interesting is that a lot of banks and financial institutions packaged all of those loans and sold them as an investment product, sold them as financial products called mortgage-backed securities. So please do remember this, that when they did that, what people were actually buying were loans that people did not have the ability to actually pay because their credit standing wasn't actually good as well. And that's why we saw countries, funds, banks that invested in it, they were the ones that were heavily hit in all of this. Now, this is where also it gets a bit dicey. And for those who were able to watch The Big Short, one of the things that also cascaded this to something that's even more dangerous is that a lot of those financial rating agencies gave very, very high ratings to those mortgage-backed securities. The loans were very risky because a lot of people didn't have the financial capability to be able to pay it. But those credit rating agencies gave them a very, very high rating. And you had a lot of funds, you had a lot of people also who placed a large amount of their money there, were the ones that actually got hit when everything started to blow up. This is where the risk comes in. A lot of those banks and financial institutions use leverage in order for them to actually invest in those very, very risky investments. You're using debt, you're actually borrowing to get into something that's risky, to get into something that may not do so well. And that's how we saw a lot of people got hit, because they trusted those credit rating agencies, but they actually borrowed money in order for them to actually invest in it. So you have to do your own due diligence. You don't listen to what everyone else is saying. And if you can avoid leverage, even better. Then another thing that made this a bit risky also is that other financial institutions packaged it into something that's a derivative. When you invest in a derivative, you're not actually investing in the underlying asset. You're just following the fluctuations. But it also has a high amount of leverage. That's why when everything started to falter, a lot of people got hit because of all of these combinations that I'm actually talking about. Another thing that I'd like to mention is this, that there were some regulatory failures that happened at that particular point in time. The regulators failed to keep in pace with the rapid innovation of the financial industry, and the existing regulations were often inadequate to be able to address new risks. And there was a deregulation. They reappealed the Glass-Steagall Act in 1999, which this allowed commercial banks to engage investment banking activities, blurring the lines between traditional banking and riskier activities. And you have a lot of banks who got exposed into this because they use the funds of investors, of their depositors, to be able to invest in these risky assets. So they had a lot of money in their arsenal placed into these risky assets. And when everything started to fall, people who deposited their hard-earned money in the bank because they thought it was actually safe were the ones also that got hit, putting the value of the bank also and all of the deposits there to be at a certain level. And I think that's what we're also seeing also in some of the banks also that got hit right now. I guess the difference is that if you look at it from a bond perspective, they mostly invested in bonds thinking that interest rates won't go up at a very, very fast rate. Please do remember, in today's age, one of the biggest issues that we're actually seeing right now is more of inflation. The Fed has started to increase rates. Banks that bought early on when rates were lower, they were suffering a loss should they need to convert those bonds into cash. If you look at also the entire narrative of Silicon Valley Bank, they had to incur a loss just for them to become liquid, and they didn't have enough cash to be able to pay or to be able to satisfy all of the withdrawals that their depositors were trying to do. Part of globalization also allowed other countries to be able to invest in this, and that's why we saw a lot of countries from Iceland, Italy to Greece also get affected in all of this, because they placed certain amounts of their portfolio into this, thinking that it was actually safe. But because, as what I've mentioned, those credit rating agencies said it was safe, but it wasn't actually safe, because the entire content of that mortgage-backed security was basically loans of people who didn't have good credit rating and good credit standing, and they didn't have the ability to be able to pay it, or they were at risk of default. That's what happened in 2008. It may seem that it's the same industry. We're seeing the banking sector and the financial sector getting hit the most, but the trigger on what has caused it to happen is totally different. And one of the things that we need to watch out also is that not a lot of banks right now have enough cash that are liquid, that should everyone start to withdraw, it would be a very, very risky proposition. That's why I mentioned this also in Twitter, that we may possibly see a lot of consolidations happen, and we're actually seeing it already right now. But above and beyond those consolidations, I think something that's very interesting is that people would put in their money into banks that are bigger because they actually trust those banks, and they actually believe that they're the ones that will actually stand the test of time as well. And all of this, at least in my opinion, gives a greater use case to Bitcoin, because Bitcoin is decentralized, Bitcoin is secure, Bitcoin is not connected to any financial institution, and you cannot shut down Bitcoin. No one can control Bitcoin. It's not connected. As long as you have it in your own hardware wallet, you get to secure, you get to protect, and you get to self-custody the assets that you have as well. It's very, very important that you do proper risk management in times like this. We don't know how times will go over the next few months and years, but the more you spread everything out, the more protected you will be as well. Those are my thoughts. Those are my takes. I hope that this was something that helped you. This was something that gave you enough understanding. If you want me to do a deep dive also on what's happening in other banks right now, put them in the comment section below, and I'll try my best to be able to answer you. I'll try my best to give you as much information as possible so you can make the right decisions with your investments. That's it for now. This is Marvin Germo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.